Welcome to today's Explainer, where we're going to completely break down the highly sophisticated infrastructure running behind cryptocurrency exchanges. Look, you already know the massive scale of the global crypto market, right? But today we're going way beyond the surface. We're going to pop the hood and examine the underlying mechanics and the technical architecture handling literal billions of dollars in daily volume. We'll be exploring the matching algorithms, those deep liquidity pools, and the high-throughput systems that make these direct digital marketplaces hum with such crazy efficiency. Here's our quick roadmap for today so you know exactly where we're headed. We'll kick things off with a welcome to the digital marketplace, look inside the trading engine, transition from theory to practice, size up the top crypto exchange platforms, and wrap up by unpacking exactly how these exchanges actually make their money. All right, let's jump straight into part one. Welcome to crypto exchanges, the digital marketplace. To really appreciate the architecture of a modern crypto exchange, we kind of have to contrast it with the immense friction of legacy systems. The old school traditional banking infrastructure has just forever relied on this fragmented web of middlemen. And what does that give us? T+2 settlement delays, counterparty risks, and really siloed regional liquidity. Digital asset exchanges completely re-engineer this whole process through deterministic execution and automated clearing. By ripping out those manual intermediaries and replacing them with programmatic rules, these platforms take global liquidity and unify it into a single borderless environment. So trades are executing and settling practically instantaneously, 24 hours a day, totally stripping out the latency and risk that have historically bottlenecked traditional finance. Okay, moving on to part two. Inside the trading engine, unpacking the mechanics. Let's get into the gears of this thing. The absolute heartbeat of any centralized exchange is its matching engine, which relies on a highly optimized order book system. This is where the actual magic of price discovery and market depth happens. Now, most top-tier exchanges use a first-in, first-out, or FIFO matching algorithm to pair up liquidity. It's basically like standing in line for coffee, but happening in fractions of a microsecond. When market participants submit requests, the engine processes those orders at lightning speed, matching the highest bids with the lowest asks. Having a thick depth of market is absolutely crucial here. It absorbs those massive block trades and really minimizes slippage. For algorithmic traders and institutional arbitrageurs, the speed at which this living ledger updates via WebSocket feeds literally dictates their entire edge in the market. So the life cycle of a single trade happens in fractions of a second, but it actually weaves through several distinct architectural layers. It kicks off at the API gateway when an order is placed, and then routed right to the matching core. Once that FIFO algorithm finds a match, the transaction executes atomically, meaning it instantly updates the underlying database states for both accounts to show the transfer of assets. But the most critical piece of this puzzle actually happens at the custody layer. To mitigate any sort of catastrophic risk, exchanges do not just leave the bulk of their liquidity sitting in hot wallets. Instead, they use intensely complex security architectures like multi-party computation, or MPC, right alongside multi-signature protocols to transfer and lock up assets into air-gapped cold storage. That effectively eliminates any single points of failure. Now for part three, starting your trading journey, theory to practice. For us as market participants, interacting with all this infrastructure actually involves a beautifully streamlined front end that totally masks the massive back-end operation. You create an account, and boom, it's instantly backed by automated KYC and AML compliance engines that are running real-time chain analysis and identity verification. From there, capital flows into the system through institutional fiat gateways. And once you're funded, market flow heavily relies on base pairs, predominantly stablecoins like USDT or USDC. These stablecoins are essentially the main highways here. They act as the primary liquidity routers across both spot and derivatives markets, letting traders seamlessly jump in and out of volatile assets without triggering taxable fiat events or relying on those sluggish legacy banking rails to reposition a portfolio. But of course, beyond simple spot buying, modern exchanges are built to handle heavy-duty, institutional-grade quantitative analysis. These platforms offer incredibly robust REST and WebSocket API integrations, which enable high-frequency trading and algorithmic market making with ultra-low latency. Plus, you get these advanced charting interfaces that typically integrate deeply with platforms like TradingView, pulling the exact tick-by-tick historical data that quantitative analysts need to backtest their complex technical models. On top of that, multi-currency wallet support totally simplifies managing sprawling, diversified portfolios. It natively handles everything from your Layer 1 gas tokens all the way to complex yield-bearing derivative tokens, all neatly packed into a single unified dashboard. Which brings us to part four, top crypto exchange platforms, the heavyweights. Let's see who's who. When we analyze the competitive landscape, it's fascinating to see how top platforms differentiate themselves through very specific architectural and strategic advantages. Take Binance, for example. They command the lion's share of the market simply through sheer aggregate volume, an absolutely massive roster of tradable assets, and these incredibly deep liquidity pools that crush slippage on large market orders. But then you have platforms like Exness, who cater specifically to precision traders, the guys running high-frequency algorithms who need ultra-low latency execution and razor-thin spreads just to stay profitable. Then there's Bybit, who has carved out a massive sector in derivatives and perpetual contracts, backed by these wildly robust liquidation engines capable of handling sudden volatility spikes. And meanwhile, AvaTrade captures their market share by expertly navigating complex multi-jurisdiction compliance, appealing heavily to institutional participants who demand strict regulatory adherence. And finally, part 5, how exchanges make money, the business model. So operating an infrastructure capable of processing billions in daily volume securely requires immense overhead. We are talking about globally distributed, ultra-low latency server racks. We're talking staffing armies of legal and regulatory compliance teams. And they have to capitalize multi-million-dollar insurance funds just to backstop tail risk events and flash crashes. So how on earth is this massive digital infrastructure funded without traditional intermediary fees? Well, the absolute dominant revenue driver is the maker/taker fee model. Exchanges actively incentivize market makers, the people who add liquidity to the order book by placing limit orders, by offering them lower or sometimes even negative fees. Conversely, they charge higher fees to takers who remove liquidity via market orders. It perfectly balances the book. But beyond just volume-based fees, platforms generate serious capital through strict gatekeeping, charging substantial listing fees for new tokens that want access to their unified liquidity pools. And we can't forget the margin trading ecosystem. It is highly lucrative. Exchanges charge interest on the capital borrowed for leveraged positions. And when those trades inevitably go underwater, automated liquidation engines step in to protect the exchange's capital while simultaneously generating liquidation penalties. Ultimately, looking at this underlying architecture completely changes how you interact with the market. When you truly understand the shift toward deterministic execution, the crucial role of microsecond latency matching engines, and the mechanics of maker/taker economics, you just get a much clearer view of market dynamics. You can actually anticipate how liquidity depth is going to impact slippage on large block trades, and you understand the multi-layered security protocols that are securing that digital wealth. Grasping the market's fundamental plumbing like this, it allows for much sharper, far more strategic maneuvering. The convergence of traditional finance and crypto just continues to accelerate, and matching engine speeds are literally pushing physical limits right now. As decentralized architectures rise up to challenge these centralized giants, pushing them to innovate even further with things like proof of reserves and enhanced API capabilities, the landscape is only getting more dynamic. Armed with a clear understanding of the institutional-grade infrastructure running behind the scenes, the market is yours to analyze. So the question is, which digital asset pair are you going to explore next? Thanks so much for joining me for today's explainer, and happy trading out there!